Today I want to talk to you about what I learned in Italy. I learned a lot in Italy. I had a great time. We're going to talk about that. We're also going to talk about the housing market. Obviously not a lot of economic news this week because of the government shutdown, but there is some stuff that came out and I want to go over that with you. We'll start today with the big three. Prices are steady. We did get a Honolulu Board of Realtors real estate report that came out for the month of September. Shows some pretty good numbers. Prices are steady. Inventory is slightly down. That could be a sideways arrow. I didn't make it red because it's really not down that much. And rates are largely sideways. Let's get into the headline news. Hey, Honolulu housing market is very stable. It is still a buyer's market, but it is stable. And show me the money. What does that mean? We'll take a look at that in a second. Housing is finally affordable. What? Larry, what are you talking about? Yes, housing is affordable, or should I say more affordable. We'll get into that. VA rates down just a bit, but not really moving too much. And finally, what I learned in Italy. And let's take a look at the Honolulu Board of Realtors, the housing market report for the month of September. And it was a pretty solid month. Median sales price really steady, $1.155 million for single family homes, $508,750 for condos. It's right about where the average has been for the last couple years. Sales year over year, condo and single family up a lot. Single family up 27.2% year over year. That's great news. Condos even surprisingly 11.5% year over year. So that was a great year over year numbers. Let's look at the month over month numbers though. September showed a really strong month with an uptick in sales overall. You see month over month up 6.6% on single family homes, up 4.3%. So that's pretty good in a time when typically you see the number of sales go down. Median home sales prices were up for single family homes month over month, down slightly for condos. We saw a surprising drop in days on market for condos. Usually you see higher days on market for condos, but there was a drop and there was a slight uptick, 22 to 26 days on market for single family homes. So single family homes, which are obviously the prices are higher, are sitting on the market a little longer. What you do see is a huge drop in pending home sales, though, for single-family homes month over month, down 20.9%, and really flat for condos. And that really leads us to, that's kind of forecasting what we're going to see in October for closed sales. Months of supply, down for condos, and steady for single-family homes. Pretty good for this time of year. All right, let's take a look at new listings. We had a slight increase in new listings, though less than 1,000 we saw for most of the year. You look at January, the numbers starting in January, we had over 1,000 new listings, really almost every month with the exception of maybe 3-4 months, but still 965, that's pretty darn close to 1,000. And you know what I see here is more single family homes coming on the market. And what does that mean? To me, that means that people who own single family homes, they see that rates are coming down. They see the opportunity to get in and make some money and punch out. It's also, a lot of people are going to move in December timeframe once children get out of school. So that's kind of what you're seeing. But really, new listings is pretty steady as well. And I would say what we're seeing here is pretty normal for this time of the year. Let's look at active inventory. We are near 10-year highs in active inventory. And for the 7th month in a row, there are over 3,000 active units for sale at 3,125. Single-family homes, not a big uptick, but a slight uptick. And what this tells you, folks, it is a buyer's market with this much inventory and not a lot of buyers because you're still sitting on the sidelines. This is a buyer's market in Oʻahu. Let's look at closed sales. 684 total closed sales in September. That is the highest since May of 2024. If you look at each of the last 2 years on this chart, you see during this time of the year, closed sales typically drop. 2024 it happened, 2023 that happened. But look, you see a gradual rise in closed sales as we head into the end of the year, and that is due in large part to lower interest rates. Now, they're not as low as we want, but they are lower in the last couple of years, and there's more inventory, so there's more opportunity for people to buy. So Closed sales moving up in Honolulu. That's not happening everywhere, but it's definitely happening here. We'll take a quick look at median sales price. You can see, if you zoom into single family homes, you can see that it's gone up. The single family home prices have gone up the last couple months, slight uptick. And then it's with condos, we're really steady, just somewhere between that 500,000, 510, 520,000 range. So very steady for condos. And at some point, the market is going to break. The market is going to break up. It's not going to go down, folks. Market is going to go up. You're going to see that median sales price eclipse 1.2 million for single family homes and maybe get and stay above 520 for condos. We're not there yet, but it is going to happen, folks. It's just a matter of time. You know what? Cash is king in real estate. 1/3 of all home sales were cash in the first half of 2025. That's crazy. That you look on your street, 1 out of every 3 purchases was done with cash. And let's break down some of these numbers. 2/3 of homes below $100,000, nearly 67%, were all cash. 40% of homes above 1 million were all cash. And 50% plus of homes priced over 2 million were cash buyers. Man, some people got money. And if you look at the states that are seeing the highest number of cash buyers, guess what? Hawaii is one of the top 5. You got Hawaii at 44.9%, is near the top of the list. You have Mississippi's the top, 49.6%. Montana at 46%, Idaho at 45%, and Maine at 44.4%. So do some of these states have in common? Well, Hawaii and Maine, they attract mostly affluent second home buyers. Many are equity rich, many are older, so they are able to pay cash for these bigger homes, and that's what you're seeing here. In Montana and Idaho, it's not necessarily that older buyers are moving in there, but you're seeing a big influx of out-of-state buyers putting cash. Maybe they're cashing out of California. I hear everybody's doing that. Maybe Arizona, maybe Oregon, and they're going to Montana and they're going to Idaho. And the facts don't lie. 45% of homes in Idaho bought all cash. If I have a friend who, anybody who's a lender in Idaho, a realtor, can you confirm these numbers? These are from Realtor.com. All right, first-time home buyers though are at disadvantage here, but they still make up nearly 1/3 of all purchases. So, my question to you is, if real estate is such a bad investment, if buying a home is such a bad investment, why are the affluent buying real estate if it's so unaffordable and it's such a bad idea? I'm kind of curious what you see. Put that in the comments. I'd like to know, why is buying a home bad, especially if everyone who has money is buying real estate? Just curious. All right. And I said housing is affordable. The affordability for housing is at a 2.5-year high. That's right. Home affordability in the U.S. has improved at 2.5-year high, thanks largely due to mortgage rates pulling back. The average 30-year fixed rate mortgage was near 6.2%, bringing monthly payments on a typical home down about 30% of the median household income versus 32% earlier in the year. So with rates coming down, again, more affordable buying a home. Continued rate softening is expected as well. Markets are projecting 30-year rates averaging around 6.25 through year end and dipping in the 6.15 range in early 2026. But it's not uniform. Coastal metro areas remain tough, i.e. Los Angeles. In Los Angeles, buyers still need 62% of the median income to cover housing costs. And borrowers are stronger today. Why? Well, the average purchase credit scores are 736. All right, that's a data set high. And debt to income ratios for new loans are at the lowest seen, or some of the lowest seen in 2 to 3 years. Rates and affordability are giving buyers and homeowners an opening that they haven't had in a while. And if you've been waiting, you might not want to wait much longer. Reach out, explore your purchase and finance options. You know what? It doesn't cost you anything to get pre-approved. At least know what your buying power is. I'm talking to clients daily, all right, about how they can afford their mortgage payment. And I'm going to show you a little bit here in the next slide on ARMs, adjustable rate mortgages, and they are changing. They are more popular now than they have been in the last 5 to 10 years. Matter of fact, nearly 10% of every purchase loan is an ARM right now. And I'm going to break down and show you some of those numbers. VA rates are steady to a little down. Not much to talk about. No economic news really this week because the government was shut down. All right, so what does this mean? Mortgage apps are down last week, 1%, but they're still up 14% year over year. Refis are down 8%, but still up 18% year over year. Now let's go back to this inventory being the highest it's been. Over 3,000 homes active inventory on market right now. Let's talk about ARMs. ARMs got a bad rap, and you know what? Some of them old ARMs with balloon payments, interest-only ARMs, with a balloon payment at the end. Those are pretty sketchy loans, and I know I had one. I didn't give one. I had one. I survived that. But let's talk about that person who doesn't want. Oh, I've heard all these. My mom and dad say I shouldn't do an ARM. They say our ARMs are bad juju. All right. Well, let's take a look at. Let's compare a 5/1 ARM to a 30-year fixed rate loan. All right. $900,000 property, VA rate 6%, APR 6%. Monthly principal and interest is $5,396. You do an adjustable rate of 5/1 ARM, same loan amount, 5.25 interest rate, so it's 3/4 of a point lower, and your monthly P&I is $4,970. That's a $426 a month savings. So a lot of my clients, they want to get under $5,000 a month on their mortgage. Well, guess what? You're not going to do that on a 30-year fixed rate, but you can do that with a 5/1 ARM. And this, it's an adjustable rate mortgage, but when you see 5, that is fixed rate for 5 years. Now, most people don't own their home for more than 4 years. The average is between 4 and 6 years. So there's a good chance you're going to be able to sell that home before it even moves. And the most it's going to move in most cases is about 1%. That could be 1%. That could be 1% down. So really, that ARM is a great, very safe product. Not like your mom and dad's ARM back in the day. This is a good product. And here's another thing. Say you take that $426 savings and you apply that towards principal. So you're making like the same payment you would have on a 30-year fixed rate, but now that $426 is going directly to principal. After that 5 years, you're going to gain an additional $37,308 in equity. That's right. Let's look at that. You go down to that principal on the amortization schedule for annual amortization schedule fixed loan. At the end of 5 years, you've paid down $62,511 in principal. But you go to that adjustable rate and you've actually added in that $426. You now have nearly $100,000 in equity in that home. That doesn't even include appreciation. So you tell me, what is a better deal? Lower payment? Absolutely. And again, it's 5 years. That's a pretty safe product. Next time somebody offers you an ARM product, have them show you the numbers. I could show you the numbers. I compare it all the time. And more often than not right now, my clients are taking a 5/1 ARM over a 2/1 buy down, because while that payment may be lower in year 1, year 2, it bumps up. Year 3, it bumps up a lot. But for 5 years, you're fixed at a low rate. All right. Again, don't say no to ARMs. Do your homework, and you might save some money. What I learned in Italy: Americans are fat. America leads the world in obesity. Over 40% of adults are now classified as obese. Meanwhile, Italy's rate is just 10%. Same humans, different habits. Let's talk portions versus pace. Italians eat real food, slower, and in smaller portions. Meals are social, not rushed. In the U.S., we eat on the go, and our bodies keep score. Movement is lifestyle, not gym time. Italians walk everywhere. Daily life is built around motion. Markets, town squares, stairs. Here, we drive a mile to the mailbox. Quality over quantity. Italy prioritizes fresh, local ingredients over ultra-processed convenience. We've traded olive oil and tomatoes for drive-through and delivery apps. Mindset matters too. Food is joy, not stress. They eat to live well. We often eat to cope. The result: longer lives, smaller waistlines, and lower medical bills. You don't need a plane ticket to live better. Just make a mindset shift. Start eating like you're in Italy. Slow down. Choose real foods. Walk after dinner. And connect more than you consume. Your heart and your waistline will thank you.